Thinking about gifting your home to your kids to avoid care home fees or inheritance tax? Well, think carefully because it could cost your financial future and home. As of right now, loads of UK families are scrambling to protect their homes from inheritance tax and the ever-increasing costs of care. In almost 20 years as an accountant, I'm seeing that more now than ever before. That's why in this video, I'm going to be explaining why gifting your house could lead to disaster, and more importantly, what you can do instead to actually protect your home and your assets without falling into some very common traps. Now, in October last year, the Department of Health and Social Care data shows around 334,000 adults aged 65 and over living in care homes. Now, back in 2021, the figure was just under 279,000. That's a huge increase. And like I hear all the time from a lot of clients of a certain age, that means retirement isn't just about cruises and gardening anymore. It's more, how do we stop the house being swallowed up by care fees? Then layer on top of that inheritance tax, IHT, up to 40%, an IHT allowance that hasn't moved in 15 years, and suddenly you can see exactly why people panic and they make the mistake of gifting their home to their children. Now, I'm going to break down the 3 big risks of gifting your home to the kids in a minute, but first, let me show you what that actually looks like in real life. Meet Ruth, a 74-year-old widow with 3 grown children. Now, Ruth thought gifting a house to her kids would protect it from care fees, reduce inheritance tax, and just make things simpler. Sounds reasonable, right? Well, it was until Ruth's eldest daughter Anne went through a messy divorce. Suddenly, the house became part of the settlement, like an asset to be divided up like a Domino's pizza on movie night. Then her son Sam was made redundant. He ended up facing really serious financial troubles. Money got tight, creditors came knocking. And as you can imagine, they were very interested in the house. Meanwhile, Ruth's youngest daughter, Sarah, she wanted to buy her own place and borrow against the home to fund a deposit. And Ruth herself, well, she's still living there, but legally, she's just a guest. No control, no veto, no safety net. She's got no say in what happens to the house anymore. Now, not long after, when her health went downhill, Ruth needed to apply for care funding. So the local council investigated her situation, and their verdict, they called it a deliberate deprivation of assets. So they treated the house as if Ruth still owned it anyway, which means actually Ruth managed to achieve the impossible. She lost control of her home and still didn't avoid care fees. Sadly, Ruth's situation isn't a one-off. Pieces of this happen all the time, with homeowners thinking they're saving money or protecting their family, but it often backfires, leaving them with a lot more problems than they actually started with. And here's the uncomfortable part with it. Ruth didn't do anything unusual. She followed the advice that thousands of people are still being given today, including trusts, which I'll come to in a bit. Which all brings us to the real question. What are the 3 big risks of gifting your home to your kids? Quick side note, if this video is already making you think, I wish I'd known that earlier, subscribing just means you'll catch the next one before you're knee deep in paperwork or panic. It also lets me know to keep making these videos as you're finding them helpful. Now, let me be very clear about this. These risks could cost you far more than you realise, and they're not the kinds of mistakes that you can easily undo afterwards. Let's start with risk number 1, loss of control. Once your house is in your child's name, it's not sort of theirs, it's theirs, which means they can sell it without your permission. They can raise finance against it. They can lose it in a divorce. They can lose it in bankruptcy. They can even have it pursued by creditors. You go from being the homeowner to hoping your kids will show you some goodwill and act in your best interests. Now, don't get me wrong, I love my family to bits, but I wouldn't put my housing security in the same category as hoping my WhatsApp messages get replied to. Let's move on to risk number 2. Inheritance tax still applies. Now, I apologise in advance. There's a quick rant coming here. If you're of a nervous disposition, now's the time to turn that volume down. So, despite being taxed when you earn, taxed when you spend, taxed when you save, that's apparently not enough, because they also tax you for having the audacity to die. In addition, the inheritance tax allowance hasn't changed since 2009. That's over 15 years. 15 years of inflation, frozen thresholds, and rising house prices. It's outrageous, and it's just so blooming unfair. You already paid tax once. Now they want to take more. Anyway, rant over, deep breath. Back to gifting. Often, when it comes to gifting property, people hear the 7-year rule and think it's a cheat code. And yes, gifts can fall outside of your estate if you survive 7 years. But there are 2 big catches. First, to qualify fully as a potentially exempt transfer pet, if you die within 7 years, it can still be dragged back into the IHT calculation, with taper relief possibly reducing the tax in later years, but it's not a magic off switch. And second, the big one, gift with reservation of benefit. If you gift the house, but you keep living there rent-free, HMRC can and do still treat it as part of your estate. So the inheritance tax saving you were promised is often non-existent. Then risk number 3, care fees aren't automatically avoided. Local authorities don't just look at when you gifted the house, they also look at why you did it. Thought control, you see, thought police. And if they believe the gift was made with the intention of avoiding care fees, they can treat the house as still belonging to you. Now, in Scotland, for example, they use a CRAG test. It stands for Charging for Residential Accommodation Guidance. In England, though, they'll usually just use a straightforward means test, which covers, firstly, financial assessment, so essentially your income. Then number 2 is a capital assessment. They'll check if it's above 23,350, in which case you'll be expected to self-fund. And then 3, the value of your home, with some protection if a partner still lives there. So it's wise to review your tenancy ownership to make sure it offers that protection. And bear in mind, as I said, the rules are different for Scotland and England. And then number 4, crucially, deprivation of assets. If the council decides you deliberately gave assets away to avoid care costs, they can assess you as if you still own them anyway. So if you give away the house, you still get treated like you didn't, which is impressively bad value. So if gifting your home is such a minefield, what should you do instead? Well, I'm going to cover a bit more on trust shortly, but in the meantime, here's the boring answer that actually works. Use your allowances properly. Now, I said to get onto trusts earlier, and I will, but let me cover the boring answer first, because it might be exactly what you need without the expense and complexity of a trust. The simplest solution is often the right solution. Each person has a $325,000 nil rate ban for inheritance tax, and if you're leaving your home to your children, there's an additional $175,000 residence nil rate ban on top of that. So for a married couple, that means you can pass up to $1 million tax-free. For many families, the inheritance tax problem is solved just by doing the paperwork properly. You know, no trusts, no gifting, no clever gymnastics with it. Just a proper will, the correct allowances used, and a bit of forward planning. It's not exciting, but neither is accidentally blowing up your finances. Trying to gift your house to save inheritance tax when your allowances already cover it is the financial equivalent of buying a flamethrower to deal with a house spider. I've actually put a free quiz below so you can sense check your situation before you speak to a solicitor, whether he's called Sebastian or not. But what if you do want to gift part of your home to your children while still living there? Well, there is a middle ground with that. You can gift a share of the property to them, but only if they genuinely live there with you. And I'm talking about them actually living there, not they pop in at Christmas and still have a toothbrush in the bathroom. It has to be a real shared living arrangement. If it's just for show, councils and HMRC will see straight through it. And in some families and cultures, multi-generational living is completely normal, and in the right circumstances, it can work. But what if you want even more protection and you're worried about what could happen down the line? What if you want longer term control, regardless of divorces, debts, family fallouts even? Well, there is a way to do that, and that's what I'm going to come on to next. Right, as promised, now we get to the main event on trusts. There are lots of different types, but for this conversation, there's three that matter. There's bare trusts, will trusts, and then the one that most people are actually asking about, lifetime trusts. Now, if your goal is to pass the house to your children and keep some control, well, a lifetime trust is often the closest thing estate planning has to Cinderella's glass slipper. Not magic, but a much better fit in the right circumstances. Don't want the ugly sister. Let me give you an example. Joan and John. So, a retired couple in good health and thinking ahead. What they want is the house to go to the kids. They want protection from sideways disinheritance, like new partners, second marriages, that sort of thing. They want a smoother inheritance process, and ideally some protection if care becomes an issue later down the line. So they set up a lifetime trust early with proper legal advice. The trust holds the house, and John and Joan retain the legal right to live there for life. Now, fast forward several years, ideally several years, touch wood, John passes away. Joan later needs residential care. Well, because the trust was set up well in advance for genuine estate planning reasons and not as a last minute panic move, the council may assess Joan's assets differently. And this is the key point. Timing is everything. If you set up a trust after a diagnosis or when care is clearly on the horizon, the local authority is much more likely to challenge it as a deliberate deprivation of assets. Early planning often works. Late planning almost always challenged. Now, whilst we're talking about this, let's clear up one huge misunderstanding. If you place your home into a lifetime trust and continue living there, that usually doesn't avoid inheritance tax. HMRC views this as a reservation of benefit, which basically means you still enjoyed the asset whilst you were alive. Morbid, right? But very HMRC. So while trust can be excellent for control, for asset protection, for probate planning, for shielding against family risks, that type of trust is not an automatic inheritance tax solution. And the key thing with trust is getting proper legal advice and advanced planning. If inheritance tax is your main concern, you've got a few options to address it. Number one, use allowances properly, nil rate plus resident bands. Number two, lifetime gifts. Make sure you survive 7 years without continuing to benefit. Number three, annual exemptions, so up to £3,000. Number four, regular gifts out of income, as long as it doesn't reduce your lifestyle. 5, advanced trust planning, like discretionary trusts, but these come with complexity and trade-offs and need specialist advice. You're more likely to actually consider a trust if you have a blended family or second marriage risk, if you're worried about children's divorces, creditors, changing things, if you want control over when the kids inherit, if you're planning early, so in your 50s, early 60s, not in late stage panic, if you can afford proper setup and ongoing admin as well, and if you've already got your will and LPAs sorted. So that's lasting powers of attorney, and you have those for finance as well as health, and they're so important. And this bit matters. It's really easy to stumble across a Facebook post or even another YouTube video that makes it seem like nothing is more important than setting up a trust. But the honest truth, what most people actually need to prioritize is getting a proper will in place, definitely getting the lasting powers of attorney for health and finances in place, having a realistic plan for how care costs might fit into their retirement. And only after that do you then even ask, does a trust actually suit our situation? And that's why professional advice matters so much. Every family is different. every plan should be too. The worst estate planning decisions usually aren't made out of greed, they're made out of panic. And panic is a terrible financial advisor. Gifting your house often feels like a shortcut, but in reality, it's one that regularly turns into a trap. Trusts can be brilliant, but only when they match the goal, are set up early and are done properly. They're tools, not magic spells. I've put a downloadable checklist below, so a nice little quiz that you can use to sense check your situation before you speak to a solicitor. It'll help you ask better questions and avoid expensive mistakes. And if you know someone who's just about to sign over the house to the kids, please share this with them. Think of it as a public service announcement with fewer sirens, slightly more spreadsheets. See you next time.